Hey everyone, welcome back to Corporate Decoder, the place where we dust off those dry SEC filings and turn them into something you can actually understand. Today, we are going to dissect a SPAC III Acquisition Corp's latest 10K report. And trust me, it's more interesting than it sounds even though that name might not mean much to you right now. This company is on the hunt for a deal and their clock is ticking, so it might feel like an episode of corporate speed dating. A SPAC III is basically a blank check company, meaning it exists to find and merge with another business. Think of it as a corporate matchmaker with a limited amount of time to make a love connection. The report paints a picture of a company hustling to find that perfect merger, racing against a very real deadline and trying to play the field to get to the altar. Let's start with the basics. A SPAC III was formed back in 2021 specifically to merge with another company, but here is the catch: they have a ticking clock. To get things moving, they had an initial public offering, or IPO, in November of 2024, selling units for $10 a piece and raking in a cool $55 million. These units are like bundled tickets, giving investors a share in the company plus a chance to grab even more shares when that merger finally happens. Alongside the IPO, there was also a private placement, where the company sold additional units to their sponsor for $2.8 million. Think of it as the company's management putting their own skin in the game, showing they believe in their own hunt for an acquisition. But wait, there is more. The underwriters of the IPO decided to buy even more units than initially planned, bringing in another $5 million. All this cash, a total of $60 million from all these transactions, is sitting in a trust account, waiting for the right merger to come along. It's like a corporate dowry, ready to be used once they say "I do" to their lucky target company. Then, in January of 2025, the company announced that the shares and rights that were once bundled can now be traded separately. This is like the company signaling to the market that the pieces are all in place to attract investors, and they can vote yay or nay in the company's future. Now here is where things get interesting. A SPAC III isn't just sitting on its millions, it's actively trying to find a match. The report reveals that they have agreements, though not yet final, with two companies, HD Group and Bioserica. HD Group, a global education platform, and Bioserica International, a company specializing in bio-based antimicrobial materials. These deals, if they go through, would be worth a total of $500 million, paid entirely in stock. This is important because the companies need to meet certain valuations, or they will not be in compliance with NASDAQ listing rules. So what kind of company are they looking for? Well, they have a checklist for potential targets that includes a competitive edge, a strong management team, and the readiness to become a public company. Think of it as their corporate dating profile, outlining what they're looking for in a long-term relationship. But here is the catch: all of this has to happen fast. They need to complete a business combination by November 2025, or they risk having to return all that money to investors. That's the ticking clock, and it puts a lot of pressure on them to find the right deal and fast. The report also dives into some potential risks of acquiring a company that does business in China, since some of their leaders have ties to China. They talk about everything from regulatory crackdowns from the Chinese government to cybersecurity reviews, all of which could make it harder to close a deal. They also mention potential accounting obstacles and difficulties of bringing action into foreign courts to enforce liabilities. This is where it gets technical. The report outlines various rules from the Chinese government that could throw a wrench into the deal-making process, including approvals needed for overseas listings and regulations on cybersecurity. These hurdles highlight the challenges of doing business in China, where regulations can change quickly and impact a company's ability to operate. The report also mentions the risk of U.S. foreign investment regulations by the Committee on Foreign Investment in the U.S., or CFIUS. Since the company may be considered a foreign person, CFIUS might step in to review any potential business combination with a U.S. business, potentially blocking or delaying the deal. Now let's talk money. The report shares some key financial figures that tell the story of a SPAC III's current situation. For the year 2024, they had a net loss of $226,383 due to general and administrative expenses, but on the flip side, they did earn interest from their trust account. As of the end of 2024, they had almost $1.6 million in cash on hand. That may sound like a lot, but keep in mind that this is primarily a holding company and that money needs to fund operations until a suitable target can be found. But here is the big one: due to the ticking clock on their business combination deadline, there is substantial doubt about their ability to continue as a going concern. In other words, if they cannot find a merger partner soon, the whole thing could dissolve. Looking at who is in charge can tell us about their experience in steering this ship, leading us to look at the company leadership. Claudius Tsang is the CEO and has a long history in capital markets, including private equity and M&A deals. He has worked at Templeton and Lehman Brothers and previously led another SPAC through a merger. His extensive background suggests he is well equipped to navigate the complexities of finding and closing a business combination. The other leaders have similar impressive backgrounds, like independent director Zhang Liu, who has over 25 years of experience in private equity, project finance, and advisory services. So the company appears to be in good hands. Lastly, the company has adopted a code of ethics applicable to its directors, officers, and employees. This code codifies the business and ethical principles that govern all aspects of their business. Now that we have decoded all the important sections, here is my final take. A SPAC III Acquisition Corp is like a race car speeding towards a deadline. They have assembled a team that is more than capable of finding a good deal. I'm concerned that time is running out and the clock is ticking. While they have identified potential targets in HD Group and Bioserica, these are just agreements for now, and the ultimate deals might look different. However, the fact that they are already in talks with companies suggests they know what they want. While the clock is ticking and the financials need to be in order, their success hinges on closing those deals or finding even better ones, while dealing with many rules and regulations along the way. It might be a bumpy ride, but it's definitely one to watch. Thanks for tuning in to Corporate Decoder. If you found this breakdown helpful, give us a thumbs up, drop a comment, and subscribe for more financial deep dives. Until next time,